if you were to take the S&P 500 and show it, year to date, it's up like 18%, right? But if you show the equal weight version of that, which just buys an equal weighting of each of the 500 companies in the S&P 500, it's only up like 3%. And so it shows that capitalization and that concentration is really driving the returns. Now, that's normal for a portfolio. The problem is what happens when those stocks have a bad day, or what happens when those spiraling like self-correct? Well, that's when it can get really, really ugly.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. And hey, we got numbers coming out. Stock market's going higher. The world is safe for democracy. Eddy Gifford's here to discuss. Eddy, great to have you back. So, hey, what's up?
Well, I mean, I don't know if the world is safe. It's funny because we got this GDP report and everything seems like it's just going so well, or came in higher than expected. But, a lot of that was due to government spending. When you really dig into the report, you see what's happened to the consumer. And consumer is not spending as planned, as the consumer came in under estimates. So, there's definitely a lot going on right now that a lot of people are excited about because the market's near all-time highs again. Of course, they're not all-time highs if you account for inflation. And then, just to take things a little bit further, when you look at the intermarket relationships and what's going on under the surface right now, there's a lot of things that are blinking kind of a yellow warning light right now. So, is Santa on schedule? I mean, right now, I would say it appears that is the case, but I also think he might be going, through a train track, and then he might get sideswiped by these intermarket relationships if he's not careful.
All right. So you think the GDP numbers are fishy?
I think that everything has been fishy since the beginning of the year. Whether we're talking about CPI or we're talking about GDP, it just seems like a lot of the stuff, the market just feels a lot more rigged lately. And not that it has always felt that way a little bit, but it just feels like there's someone behind the curtain pulling the strings. And, every time that it seems like we're going to break, somehow magnificently we bounce back, and it's pretty rapid. I mean, when we look at last month, everyone was calling for doom and gloom. And I would say that it was a justified doom and gloom based on what's going on. And we saw that thing bounce back faster than anything we've seen, even faster than COVID. So that's not normal behavior, And when you look at the markets over the last 3 years, most of the gains have happened like right in conjunction with earnings, right? Basically, like the 7 days at the end of the calendar month, and that typically happens in bear markets, not in bull markets. So there's just a lot of like weird things, weird anomalies that are occurring that make you feel like you're in a bear market, but yet we're right at or close to all-time highs, at least in the S&P and the QQQ, the NASDAQ. Of course, Russell and retail and are telling another story. So usually it's the small caps that prevail to the upside or the down that provide the confirmation. And right now, the small companies are struggling.
Yeah. So, the economy looks bleak, but don't stocks climb on a wall of worry?
Well, and generally speaking, yes. I mean, we've had like this wall of worry all year, and the stocks have kind of like drifted upwards. Of course, it's what stocks are we talking about? There's a ton of concentration right now. The Magnificent Seven make up 7% of the S&P 500 right now. And if you were to just, I was showing a client this the other day, if you were to take the S&P 500 and show it, year to date, it's up like 18%, right? But if you show the equal weight version of that, which just buys an equal weighting of each of the 500 companies in the S&P 500, it's only up like 3%. And so it shows that capitalization and that concentration is really driving the returns. Now, that's normal for a portfolio. The problem is what happens when those stocks have a bad day, or what happens when those spiraling like self-correct? Well, that's when it can get really, really ugly. I'm not saying run and put your hand under a mattress and just and don't invest. You have to invest. I mean, we've got to beat this thing called inflation that wasn't real and now it is. But if you are investing, you just got to make sure that you have you have to have a reason to get in. You have to have a reason to get out, and those have to be predetermined. You can't just decide one day, oh, I think I'm gonna buy Apple, and then the next day be like, oh, I think I'm gonna get out of Apple. That's not how it works. Not if you want to be successful long term. You need to have a disciplined strategy that you follow that has a predetermined reason to get out. And I think that a lot of portfolios are missing that, unfortunately.
All right. So you're not convinced about this bull market yet, are you?
I'm definitely not. I think there's just too many things under the surface, too many cracks under the surface. The consumer is, the consumer is spending. It's fantastic, right? And the government is spending. It's fantastic. Except for when all that spending is built on debt, what that leads to is a significant bubble. And I don't know if we're in the same scenario that we were in like 2007-ish, prior to the 2008-2009 financial crisis, but it's starting to feel similar. I mean, the difference this time is it's our government that's really in trouble, and the consumer is in trouble too because of all these high interest rates and just because of the high credit card balances that we're seeing. So yeah, the only thing that's saving us is a lot of people were smart enough to refinance during COVID, and so they have a low house payment. But the more they consume, the more the other debt goes up, and then at some point you hit a wall because we don't have that unlimited credit line like the government has. So
unfortunately, not.
No, so we're gonna hit that, and when we do, it's not gonna be pretty.
Yeah, no doubt. So when are we gonna hit it?
Well, if I had a crystal ball, we'd all be gazillionaires, right, Kerry? I think that, if we're looking at it, I would be looking out probably 6 to 9 months. Now, I could definitely see it being pushed to the other side of the election, just from the standpoint that our leadership has shown they're very, very good at kicking cans down the road. And so, obviously, if they can get it to the other side of the election and they can blame it on the new president, that's a much easier way to do things, right? So,
sure.
To think that there's not politics involved, is silly. I mean, we've seen how political things have become over the last 5 to 6 years, and we're heading into next year, which is an election year, which probably means a lot more yelling and screaming at each other. So, whatever we can do to basically distract what's actually going on, and what's actually going on is that consumers are having a harder time paying their bills. They're maxed out on credit cards. There's that they're not going to go and refinance their house to consolidate, because now they got to go from a 3% mortgage to a 7% mortgage to do that. So it's going to hit that point, and I think that it's one of those things where we'll all look back and be like, oh, that was so obvious, right? But it always surprises you still. It's like, yeah. I remember when my grandmother was really sick, and it was like I knew she was going to pass away, but when she did, it still hit me. It was like the same thing with these financial events. It's like, they're coming, and then they hit, you're like, oh man, I knew it was going to happen. I didn't do anything about it, right? So I don't think this time is different, even though that's what they keep telling us.
Yeah. All right. So what are we supposed to do here? We're supposed to just sit here and wait for it to happen?
Well, I think that when we're looking into the end of this year, I think that we're in an okay spot when we look at kind of like the metrics, the market internals, and what's going on. It looks like we do have some upside into the year. I would definitely have stops and targets in place on my portfolio. If the holding goes down by 15%, cut it loose. There's no reason to hold on to it if it's not doing what it's supposed to be doing. And as it rises, take some profits on the way up. That's a way to kind of put some money in your pocket. I'm a Vegas guy, so the casinos are down the street from me, and the first rule is get your gambling money back in your pocket as soon as possible, right? So just be disciplined in what you're doing. Don't be scared, but at the same time, it's okay to be nimble and flexible. And right now, cash is paying 5%. I'm not a fan of just holding cash, but I understand why a person would.
Okay, so cash is king. I thought cash was trash, but I guess I was wrong. So you think we're going to have an event, but of course, you're in the same boat as the rest of us. None of us know when.
No, if we could call that's what gets movies made about us, right? So, but I mean, it's coming. I mean, and it feels like this slow fuse, but like when it actually reaches its end point, it's usually sudden, it's usually fast, it's usually very painful.
That's for sure. Hey, so what about the gold going up? What do you read into that and the dollar going down?
So gold has been the primary thing that I've been watching over the last 2 weeks. Gold is definitely giving us a warning signal right now. It's been outperforming wood or lumber. It's starting to outperform the S&P 500. And then even if you go and you look on like the other side of the risk off zone, the TLT has also been outperforming the S&P and has also been outperforming high yield. So those are typically risk off warnings. The only thing that we're seeing that usually like tips over to is utilities versus the S&P. Right now, S&P is still outperforming utilities by a little bit. Of course, it just depends on the time frame that you're looking at, but we see that flip too, and we're kind of in like a 100% risk off type scenario. That means hedge your portfolio if that happens, or take some profits for sure.
Yeah. All right, I buy it. All right, Eddy, where do we find you these days? How do we connect with you on the web?
Same old, tactivewealth.com/Eddy-Gifford, or just jump on to Google. Type in Eddy Gifford. That's Eddy with a Y, EDDY, Gifford, Gifford. And you might even find me on this show. So,
all right. And the links in the show notes to this interview on financialsurvivalnetwork.com. Make sure you go there, sign up for your free newsletter. And if you got a question for Eddy or myself, the email's kl@kerrylutz.com. Eddy, appreciate you taking time out for your busy day and sharing your wisdom with us. We're just going to sit back and see what happens next.
All right. Sounds good. Thanks, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.